Good morning, everyone. Welcome to Opening Playbook for Wednesday, August 19th. Happy Hum Day. Hope you're having a good morning so far. And we are joined by the one and only Mr. Nathan Tucci. How you doing?
I am doing wonderful. How are you?
I am doing all right as well.
All right. Well, how is everyone else doing? I don't really care how Dave's doing. I care how everyone else is doing. That's the real question here today. Just kidding. We love Dave. We have lots of Daves here and in the audience. I mean, like Dave's, they just kind of own the trading world, it seems.
We multiply. We multiply. We like to overwhelm people with our numbers.
You overwhelm me all the time.
Yeah.
All right. Well, folks, we have a nice positive day starting to drift a little bit back to the right direction. I say the right direction as in the correct direction, because when the market goes where I want it to, that's the correct direction for the market to go. I have this 77.30 SPX trade, so I need about $8 there, or 0.1% to get me into a nice profitable trade. If you guys happen to get filled on target, really good open cross right through the middle of the threshold there. Now it's up, but it kind of crossed right back through 152. So it was actually sitting at 0.0%, which is pretty good for a calendar trade for a very short period of time. So if you were managing it, Even so, still, still should be in pretty good shape. But for a minute there, it was in really good shape. We have gold and silver ripping. We have insurance moving quite nicely as well. We had actually Progressive Insurance was up almost 5%. Now got ripped right back down, only up about 2.5%. GDX, which is a trade that we put on as a pair trade to see if it could outperform gold, is outperforming gold in a big, big way. So if you guys did the GDX pair trade, crushing it on that. And if anyone was crazy enough to take that butterfly trade yesterday, I think you, Dave, I hate to put you on the spot. Do you remember what strikes we did, that pin was?
Yeah, we pinned it 77.45.
Okay, so you probably are up 100% on that trade right now, would be my guess, maybe 80%. If it moves into that 77.40 range the second half of the day, that's a 500% kind of potential trade. And then if you held it for the 1,000%, then you're just crazy, but you could do that as well. All right, let's talk about where the market is right now because we have a very strange sector leading the pack. I'm sure some of you guys may have seen. We got the big news on the healthcare sector with a headline about potential cancer drugs. And let me show you what that looks like right now on the sector. Okay, so you guys see XLV today just absolutely storming the castle gates, up higher compared to everything else. That is the healthcare sector, XLV right there, ripping to the upside on the back of that announcement. Some of the stocks moving there, as you'll see. I don't think they'll even show up on my heat map, right? Because I don't think it's top. Yeah, and Amgen's not even top 100 market cap. But some of the other, because the deal they did, I guess, was it Merck, Moderna, and Amgen? I forget exactly who all was involved.
Moderna and Merck, yeah.
Okay, they're ripping today. Moderna, which I don't, like I said, I don't even have on the top 100 market cap, is up. I have delay. Why is TradingView doing this? I'll let you guys know tomorrow what the chart looks like, but it's up a lot. I think it's up over 100%. So we have a lot of interesting activity happening on the healthcare side, but like I said, it's not the only thing happening. Gold and the gold miners are ripping. A couple of software names ripped quite nicely. Eli Lilly, as part of the health run, has moved up. And so it's a very interesting day because the market is green overall. The SPY is green, but look at the Qs. Trailing almost 0.6% behind. Well, now trailing over 0.6% behind because the other names like SMH today is absolutely dead in the water, moving down over 1%, participating zero here today. And yet the market is up, which we have not seen much of lately. Obviously, the gap down the last couple of days was enforced by SMH, pulling us down. And today it's continued some downward pressure, but the market is up because the other sectors are doing a lot of heavy lifting. And if you look at the chart, there you go. Communications up over 1%, discretionary up over 2%, healthcare up nearly 4%, basic materials up 2.5%, energy's up, staples are somehow up 1.5%, I guess, because Target and Walmart had a little bit of a rip. And then technology, the big dog on campus, is down 1%, but we are trying to move this market higher in spite of it. So it's just a tug of war between the underbelly of the market trying to move us up and technology. By the way, it's not, we talked about this yesterday. Mags are up, ladies and gentlemen. So when we say technology is dragging the market down here with this 1% move, we're talking about exactly what we forecasted yesterday, where you have the very concentrated AI trade. So we looked at this memory trade here on DRAM. It's bouncing a little bit right off the moving averages. I think it's a buy, by the way, just purely from a risk reward standpoint. DRAM, it's the memory side. It's getting a little bit of a boost up, but then you have your big chip stocks. SanDisk down about 3%, Micron down about 1%, AMD down about 4%. I didn't look at NVIDIA yet. What's NVIDIA? Just down a hair. Ooh, NVIDIA looks like a buy. I'm tempted to buy up right now. I have to say, I'm being disciplined, and I'm not going to do that. But I might do a risk to find on DRAM and a couple others. So in my mind, this is just a pure tug of war between technology and the rest of the market. And it's not even technology; it's really just some of these chip stocks that are pulling us down. So we'll see who can win the day. If the market can get up to 77.30 ish, then we have a really nice outsized winner on the trade that I gave you. We're only $3 away. We have a really nice on the one from the morning market. If we can get to 77.40, is that the number? 77.40, 77.45. If
45.
we can get to 77.45, then we can have a 500% winner on the trade that I didn't take, but I will certainly claim victory anyway by the end of the day. So we'll see. All right.
You want to maybe just for 30 seconds tell people why you consider it discipline to not get in that trade right now?
Oh, yeah. I mean, for me right now, even if I have kind of a snapshot bias of looking at the market and, oh, I like this chart looks good, I still have an overall structure that I am trading within. And right now, that overall structure is still non-directional. So when we look at that S&P chart and we say, okay, where's the market to go from here? My prediction is probably going to fill the middle of that gap sometime this week and then make a move in either direction from there. That's not a basis where now the rest of the trades fall out from that, be super aggressive and go long every which way. It doesn't mean that there's not some opportunities where that makes sense. Risk to find on something like DRAM, I actually do like, but it means I have already stated that my directional bias is neutral. I'm now not going to put a whole chunk of my portfolio on something directional because it looks attractive on one individual chart. So I find that having an overall bias in the market is helpful more so for controlling what you do with your risk on everything else than it is an individual trade like a butterfly trade on that particular asset. Hopefully that answers that question. Okay. So today we're going to nerd out as we do on Wednesdays with our option nerds session. We are going to talk about the width of spreads, something that I feel like not everyone likes to talk about because they might think it's boring, but I think it's kind of fascinating. And so we're going to talk about that today. We're also going to see if NVIDIA goes higher. Those are the two things on our agenda. Here we go. All right, so I'm going to get into presentation mode here on our little nerdy option Wednesday and talk about the idea of whether the width of the spread matters. Hint, yes, I think it matters. And we'll talk about specifically the ways in which it matters here today. By the way, if I didn't shout out to everyone, I apologize. I was a little bit late here, jumping right on at 10:30. But hey, everyone, Rich, Rolly, Roxanne, Savannah, Robert, Chicago, Ricardo, Joseph, Dave, Mike, RJ rather, Susan, Joseph, Mary, everyone. Hello. Golfer 6731. Now there's a name I can get behind. Debbie, everyone. Good morning. I hope you guys are doing great. Thankful to have all of you here live with me today, and I hope that you learned something valuable. So today we are getting into something that is a little bit different because we talk about trade opportunities all the time. We talk about which direction, which strike, how our ROI looks or our expectancy looks. But there's one piece of the trade that we really typically don't spend a lot of time talking about. And most people that I listen to, it actually doesn't come up at all, which is the width of the spread. Okay. Because typically what happens is you pull up a vertical. You say, okay, we're going to trade Apple long. We're going to go for this price. You pull up the vertical and it automatically is going to set up with the narrowest spread that's available. And so that's the one that almost everyone trades. Okay, you had the trade idea, you clicked vertical, and then boom, you just took the one that was pre-set up for the area of the chart that you're aiming for. But of course, you don't have to do that. You don't have to take the narrowest version of a vertical trade. You could pair any two strikes you wanted. So the question is, what happens if you go wider? Because you're usually starting out with the narrowest option available. If you go wider, what do you gain and what do you give up? And so today, I want to walk you through two areas where going wider can be a real advantage. So, quick recap on what a debit spread is for those of you who are like, okay, Nate, you're talking about with the spread. I'm not even caught up on the debit spread. I'll give you just a very quick summary of that. A refresher on how the middle of the spread works. That's the part that almost everyone ignores, including me, frankly, in most sessions. If I'm kind of going through quickly, don't spend much time on that. And then what happens if we open that middle area up? What does that affect? Can it be an advantage, etc.? So, debit spread verticals. Let's go over the 2-minute version of what that actually means. Whether you are bullish or bearish, you are buying the option closer to the direction you're trading, and then you're selling an option further out with the same expiration. That's a debit spread vertical. The one you buy costs more than the one you sell, so you're paying the net difference. That's why it's a debit spread. So the debit is just literally what the trade cost you. And it's also the most money you can lose. So if I buy a $1 debit spread for 60 cents or $60 a contract, that's what I can lose. Now, the distance between those two strikes is what we would call the width of the spread. And the width of the spread is actually incredibly important because it's the width of the spread that determines its max potential value. So the width minus the debit you paid is actually the most money you can ever make on a vertical trade. So to give you an example, if I do a bullish debit spread on Apple, I buy the 250 call and I sell the 255 call. They each have their own individual prices. What I pay is the difference. I might pay $4. How much money can I make? That's determined versus or based on the spread. Okay, so the spread, because the 250 and 255 is $5, I paid $4 or $400. So my max gain is now $100. Joseph said short versus long. Well, this is a debit, so that means long in terms of, structure, but you could trade it with puts or calls. Okay, so structure is long, directional. It's a debit, but you could trade it with puts or calls. Okay, so again, that width is what determines the max value of the trade. Now, here's the part that matters for everything else. I usually call the strike the line in the sand, right? That's what we say. Hey, we need to get over this level. It's the line in the sand. Today, SPX, I have that 77.30 on the one directional trade from yesterday as a line in the sand. Above it, you win. Below it, you lose. And that's how we think about verticals, or at least the easiest way to kind of talk about verticals and explain them. But of course, that's not actually true. It's not actually a line in the sand because the line isn't a line, it's a range. And everything between the strike, that whole, 255, 250, that $5 range is really what you're trading around. So that line is really a zone. Okay, let me pause here and ask everyone if this part, if we made sense so far. Okay, because if we haven't made sense so far, the next part's going to be harder. But hopefully this makes sense, because what we're saying is that typically we think of this line up here on a bullish trade, the line in the sand we think of, but in reality, it's this range because there's value in between those two levels as well. Okay. I don't know why I can't draw on that. Sometimes that happens and I have no idea why. Oh, well, maybe if I don't know if I refresh it, if that would make it work. No. Okay. Not sure I can draw on there. All right, good. So if the stock finishes in between, the one that we sold is worthless. Why? Well, because we sold 250. So anything above that, this is still worthless. But you do have the one you bought. Okay. So 255 sold. Anything down here, 255 is worthless, right? It's not in the money. But we bought the 250. And so if price is above 250, guess what? That is in the money. Okay. So we're left holding the one we bought. So the value is just where it closed minus the strike that you bought. Okay, so if you have a close on that trade at 251.35, you got $1.35. And I say, kind of, because it exercises at $1.35, but of course it does that at market close or actually in the after hours. So what really matters is where the price ends up. But your value for that particular debit is the level plus however far it is in the money. So this is why you will often see a break-even price listed with the vertical, which is going to be the strike you bought plus what you paid for the spread. All right. So then the question becomes, which trade is better? And of course, it's going to depend on the underlying. So it's kind of a trick question. But theoretically, which one is better? I could buy the 250, 255 and have a debit of $4, or I could buy the 245, 255 and have a debit of $8. Same idea, same ROI, right? Literally the same line in the sand, same ROI. But sometimes you can get better room on the wider spread. So let me pause again. Does this make sense? Okay. You have the same structured trade where you're looking for Apple to be above 255 in both scenarios. You have a 25% ROI if you get a full winner above 255 in both scenarios. But occasionally, depending on the actual value of the trade, your break even could actually be moved lower or higher on a wider spread. Okay. So this is going to affect the overall dynamics of the trade, because the area where you start making money, and specifically the area at the end of the trade, could actually shift based on the width of the spread. And that's where the rubber kind of meets the road in terms of whether this matters or not. Okay. Does that make sense? Just give me a quick yes in the chat if you're following so far. Okay, good. Okay. Now, sometimes that middle range can actually do work for you. It can actually help you. Other times, it can just cost you ROI. So you kind of have to navigate the differences between when it's an advantage and when it's not. Anyone trade overnight options with me last night? I actually didn't even do this on purpose. It's a total coincidence that we happen to be talking about this the day after I went too wide on overnight options last night instead of one wide, because I could split the difference and still get the ROI while keeping my defensive trade where I wanted. If that doesn't make sense right now, maybe it'll make sense here in about 5 minutes why we did that on overnight options just yesterday. I literally didn't even plan that. Happened to be yesterday's trade, one of the rare times that I do it, connecting with this lesson. So the first spot is where width can help you is when you want to be defensive. Okay. So you want to be defensive like we are in overnight options, and you need some width to help you. What do I mean by that? Well, let's say the SPY is at 600 and I want to be very defensive. I want to trade a 1 DTE, 1 days till expiration trade that can survive a $5 drop, which is very defensive for a 1 DTE trade. So if I go to $5 in the money, just like everyone trades, and I go to buy the 595 because that's the line in the sand I want, if I click vertical on SPY, what trade is it going to offer me on the vertical? It's going to offer me this 595, 596 vertical trade, because I went down to 595 as the area that I wanted to trade, and I clicked vertical, and so it's going to give me by default that $1 wide trade. Okay. Now, if I actually go to take that, the trade's probably going to cost about 99 cents on the $1 wide, right? Because it's so far in the money that it feels very safe. The market's going to give me very bad value for that trade. So the most it can be worth is $1. I'm spending 99 cents. I have about 1 penny worth of profitability. Okay. Does anyone in here, I'll add a question mark in here. Anyone in here want to take that trade where you risk 99 cents to make a penny? And I like negative risk reward trades, but even for me, 99 cents to make a penny is a little bit extreme. So one way to make the same idea of the trade more viable is to open up the middle of the trade to give yourself some width. So you take the exact same long strike, your exact same max risk defensive position, but instead of selling the 596 like we just were a second ago, sell the 598 instead. Same idea of the trade, but it constitutes the risk reward a little bit differently. Okay, now we're $3 wide. Instead of it being $2.99 and only having a penny, it still is a negative risk reward. Of course, it's still very defensive, but notice we have taken the same $5.95 kind of core level and we put some more meat on the bone here. $2.60, most can be worth is $3 because now it's $3 wide. Now we have 40 cents of potential. Same long strike here, okay? We're still buying that $5.95, same idea of the trade, but now we've fabricated some meat on the bone of the trade. Okay, so again, instead of risking 99 to make $1, we're risking 260 to make 40. Again, still a negative risk reward, but now it's within reason. It's a 6.5 to 1 risk reward instead of a 99 to 1 risk reward, just by widening out that spread. Now, let me just be very clear and straight about the trade-off here. If the SPY closes tomorrow at any of these levels, it's gonna structure the trade differently. We still need it to be above 598 to get the full winner. Over here, we would win in more scenarios. Your win rate would be higher, but of course, your risk reward doesn't work at any of those scenarios versus over here, it does start to work. So on the narrow one, the SPY can fall all the way to 596, and we would theoretically still make a penny on the trade if you wanted to make a penny on the trade. On the wider one, we do need to hold above 598. Okay, below that, you start to give back value. So it's not exactly the same trade, just to be super clear. $3 drop would be a win on one and a loss on the other. Well, yeah, a loss on one. But if you look at the bottom row here, okay, down here, if you look at that bottom row, they both go to 0 at 595. Okay, so you still have that same max risk function in terms of price action, but you have a trade that you don't have to risk 99 to 1 to make it work. Okay, does that make sense? So being more defensive and finding some room is one potential advantage. Is everyone, I just want to pause here for a second again. I know I asked for a lot of yeses in the chat. When we get into these nerdy topics, I want to make sure you guys are following me, at least conceptually, even if you don't fully understand how you would do it mechanically. You're basically saying, listen, the trade's not exactly the same, but at the same floor idea, one trades at a 6.5 risk reward, one trades at a 99 to 1 risk reward. This trade becomes more viable, even though it's not exactly the same trade. The risk reward at the same exact function at the floor level is much more achievable in one trade relative to the other. Okay, so that's really the core advantage for a functional trade. What happened in overnight options yesterday, let me show it to you. See here. So what happened in overnight options, we were setting up our trade yesterday. I'll go to the SPY. Okay. We were getting into the end of the day and the market was going down. Okay. Sorry, I'm bouncing around all over the place here. Okay. And what happened is we got down near the end of the day and there was really no room for the $1 trade because the VIX is fairly low right now. Okay. So since the VIX is very low, we couldn't be very defensive. And I said, well, I don't want to do $1 wide right at this price because then just $1 down, it's an entire 100% loss on a small move with not very much room for error. But I also don't want to go one lower at a $1 wide because then the trade's too expensive. Okay. So basically, if you think about it like this, here, I'll try to draw it for you. Maybe this will make sense. To be fully honest, I have no idea if this will make sense. I'm going to try to make it make sense. Okay. So the original intention of the trade was to do a 767 here and a 766, right? Yes. Okay. $1 wide right here. This was the intention of the trade. The problem with this trade was I said, wow, that's really close. I would rather have more buffer because a $1 move, I'm going to be all the way below the 766 line. That's a full loss. Okay, so then what we would usually do is we would say, okay, well, let's just move it lower and do 765. And now we have more protection, right? We have a bigger range where we still get value. The problem is this trade was too expensive because the VIX is low and it just wasn't giving me any value. So what did I do? I actually combined the trades and I did 765 by 767. Okay. So what I did is I kept the line in the sand close enough where I got value on the trade, but I kept value with more floor, with more defense by making it wider. I literally split the difference between the trade that was too close and too easy to take a loss versus not enough risk to reward. I combined the two. I widened the spread by $1 and we got our trade where we still had enough meat on the bone to make a good trade. Okay. Does that make sense? Hopefully that's a good practical example of how this can work in real time. I didn't even plan this. I just happened to do it yesterday there. Okay, Bob said no. So Bob, the issue was if I kept the trade up here, I made it too easy to lose 100%. If I moved the trade down here, the trade was too expensive. So I couldn't get enough risk to reward. So what I did is I combined the two. That gave me a wider spread with more value available so I could get a better ROI while still keeping the floor. So even if we did go down $1, I'm now not losing 100%. I'm only down 50% on the trade. So I literally combined those two. The only way that I can do that is by widening the spread. Instead of taking a $1 wide, I took a $2 wide, same floor, but a little more value inside the trade. Okay, so that's the example that we did yesterday in overnight options, hit our target this morning on that trade. Roxanne said, and it worked. Yes, I wouldn't have given you the example if it didn't work. No, I'm just kidding. It still would have been a good trade. I still would have been the right decision, even if it didn't work, but it was nice that it did work. Okay, so being defensive like that exact example to give yourself some meat on the bone is one potential advantage. No, actually, wider does not always mean better break even. I'll go through that a little bit here, but not always, because if you got a bad price on it, it could flip the other direction. But there's a much bigger thing to consider, especially on active systematic methods. Okay, so that risk reward idea, that break even idea is one, but there's actually a bigger part about width. Does anyone happen to know it? Just out of curiosity, this is especially true with active systematic methods. There's actually a bigger reason to consider wider spreads than the example that I just gave you. I'm curious if anyone already knows. If you trade something like Bullseye or even overnight options, Dave T, my man, fees. This is a huge part of the equation that no one seems to talk about, but it is a big part of the equation of why width can matter a whole lot. So if you're taking a trade every day or every week, fees are no longer like a rounding error about what your ROI ends up being. And the easiest way to lower fees is to widen the spread. Let me give you an example of this with SPX and XSP. It's a great way to do the example because they essentially are the same asset in the same trade, but they trade at different prices. So again, XSP is just 1/10 of SPX. Smaller contract, but exact same index, which means one SPX 10 wide is the exact same position as one XSP 1 wide. Exact same position, and 10 of them equal the exact same risk parameters as well. Okay, so if you think about it this way, if I do a one, well, let me think, how do I say this so that it's not confusing? If I do a contract $10 wide and I do 2 of them, it's the same as doing a $1 wide on XSP and doing 20 contracts. All right. And so you might have a situation where you have a max value being $1,000 on the trade because it's 10 wide and it costs you $600 to get into the trade. Same idea, but 10 times the contracts. So you have the identical position, identical risk, identical payoff, just built differently because one is on SPX and one is on XSP. So let's run a strategy on both of these, just a theoretical strategy because it doesn't really matter. Hopefully, it'll make the point to you about why this matters. Okay, so here's our example strategy. We have an example strategy that trades every day over a couple of years, 4 years, 60% win rate, 30% average winner, 30% average loser, cost per trade $600, works out to a net advantage of about $36 a trade before any costs. And of course, before any costs, this is going to be an important part of the equation here. Before any cost really matters. So if you do the math on this over the cumulative return, $36 a trade times 1,000 trades is going to be $36,000 in cumulative returns. And you have a beautiful chart that looks like this. I would trade that chart. It's beautiful. Okay, now the fun part. What happens when you add the fees? Okay. The SPX version is 2 contracts a trade. The XSP version is 20 contracts per trade. And SPX compared to XSP, you have roughly 6 times the fees. Now, someone in the chat is going to say, Nate, you're really bad at math. You just said it's 10 times the contracts. How do you have 6 times the fees? Well, because there actually are some different exchange fees between XSP and SPX. SPX has some higher exchange fees, even though the commissions are better because it's less contracts. And so it ends up being about 6 times the fees, not 10 times the fees. And when you do that, you get the identical strategy, identical win rate, identical ROI per trade. Every metric in the strategy is identical except for the fees that come out after the fact. And this is what it can look like over the course of 1,000 trades. Again, every trade finishes the same. You didn't change any winners to losers. Just the fees between those two strategies on the identical structure. Same win, same losses, same everything. On the 36,000 in profit, you kept 86% of your profit. On SPX, you only kept 17% of all your profits on XSP. Now, this is very active. If you're trading a weekly strategy or monthly strategy, the impact is much lower. But a lot of us are trading very active, and you can see how dramatic the fees, play a role in here when you do that. So again, functional identical strategy in every possible way except the width of the spread is the only difference. So 2 things here, hopefully you guys get in the summary. Widening the middle can turn a trade that isn't worth taking into one that is, because you just create more value, what I often call meat on the bone in the same trade idea. And on anything you run systematically, widening that spread can be the difference between a strategy that works and one that just gets eaten alive with the fees. So those are really the 2 takeaways from why, at least in my opinion, for where and why and how the width of a spread can really matter. All right. Any questions? Did we learn something? Nerdy topic today on the width of a spread, but hopefully made some sense by the end of it.
I think so.
All right, I'll hang tight here for 2 minutes in case you guys have any questions. Oh, by the way, if you guys weren't in closing playbook, I mentioned I'm upgrading market maps here. I'm giving everyone who has market maps the dashboard version of it. So if you kind of want to sneak your way in and just join the regular market maps, which is just $3 a month, you also will get upgraded for free to the entire dashboard, which also has some undisclosed bonuses in it that I have not mentioned yet in there. So if you guys want to do that, $3 a month. It's very hefty. But the cool thing is you will also get a if you're VIP, if you're HQ or whatever, you get it for free. Obviously, you don't have to do anything there. But I'm trying to release that Tuesday or Wednesday next week. And I'm just going to upgrade everyone who's in the Market Maps Telegram for free. But if you're not in the Market Maps Telegram and you want to jump in just so you get upgraded for free, you can do that.
Cool. Well, I just posted the link.
Yeah, so if you guys are asking what am I talking about, it's the dashboard that you guys will see me use here. So this dashboard where you get all of my snapshots, you get the sector view, you get the heat map, you get some of my other cool stuff that's in here. You get the trend snapshot, this movement ratio, which should really be an entire service on its own. I think it's one of the best pieces of information you can get anywhere, and I've never seen anyone else do it. It's well, it does take 2 minutes to load, but other than that, it's amazing, and it's worth its weight in gold, in my opinion, if you trade the way that I like to trade. That's in there. It does have to pull all the options, so it takes a minute to load. But there's all kinds of cool stuff in there. In my opinion, it is worth a lot more than $3 a month. Like I said yesterday, no pressure on this one. You joining for $3 a month is not going to make any difference in my life. So it is really no pressure at all. It's just for the people who want to take advantage of it. You'll get the actual dashboard version as soon as I release it, which is kind of a no-brainer in my opinion. So check that out if you want it. Okay. Question there. Bottom line on SPX versus XSP, Roxanne. The bottom line there is if you have a big enough account to trade SPX and just carve your contracts to 1/10 the contracts, because 10 contracts on XSP 1 wide is equivalent to 1 contract on SPX 10 wide. You get a huge advantage over time simply on the fees, even though the trades themselves will literally be identical. Oh, by the way, I got filled on our SPX trade. Boom, 100% winner on SPX from our morning market from yesterday. I didn't take the butterfly trade. That one's up, I assume, even more. I'm not sure if anyone took that and can give me an update on how much. I would assume that one's up maybe 150%, something like that. But our one that we took in the morning class yesterday got about 100% ROI, so we'll take it. Will it include the levels and percentage at close and entry from 9:45? Oh, Deborah, you're talking about the pre-market, not the pre-market, the members meeting dashboard. I don't have that in there, Deborah. That's kind of a separate thing that I do with a different data source. It's not in the market maps. You can kind of piece it together in some ways, but it's not the same thing. Dave asks, can you get more than 100% on a simple spread? Actually, Dave, yes. Common misconception, there's an unlimited ROI potential on spreads. So it's capped once you make the spread, but you could go build a spread that has unlimited ROI potential. I'll give you an example. You could go to the NQ right now for the end of today, find something that's 10% out of the money, make it $500 wide, trade it for 3 cents, and you're going to have 10,000% ROI potential. Of course, you'll lose, so there is that to consider. But you could make the trade with massive ROI potential. If you're not familiar with how that works, my debit spread class, which I do think Dave posted earlier, is kind of your starting point there to understand that structure and how the ROI potential actually works.
Yeah, I posted it a couple times if you scroll back, or I could post it again. But the $1 opening playbook members area has lots of good training on spreads. Here, I'll repost it. There we go.
By the way, Q's did flip green, so we have some life right now. Still need SMH. If SMH flips green, we'll be off to the races. It has not done that, but QQQ has flipped green. XLK has not. SMH has not. So we'll keep an eye on that.
By the way, I've posted a handful of different links for people throughout the session this morning. All of them are always available behind the bullhorn icon at the top of your chat window. So if you look at the top of your chat window, there are a handful of icons in a green background. The second one, the bullhorn, says announcements when you hover over it. We have links in there that cover everything. The last one is a link to a bunch of other links. So they're really more like 25 helpful links. If you just click on that last one, you'll see all of them. But I pulled out a few that are always available under the announcements there, such as the replay link and all that kind of stuff, our schedule, etc. Larry says he's up 216% on that butterfly from yesterday.
Oh, I like it. All right. Nice, Larry. I won't actually claim credit uh, for it. I will only give you credit because you were brave enough to take it. Okay. Well, folks, appreciate everyone jumping on opening playbook as always. Hopefully, our lesson today wasn't too nerdy. Hope you enjoyed it, and we will be back Friday. Actually, I think Graham might end up doing a bonus session tomorrow. He mentioned potentially
Yeah,
doing that.
that's the
Okay.
plan.
Okay. I
Um,
wasn't sure. I kind of lost track of the
yeah, so since
thread
Graham
there.
wasn't able to be here yesterday to do his weekly market recap, I know he's planning on doing it like a bonus session because with the new schedule, we don't have opening playbook on Thursdays normally, but Graham's going to do kind of a makeup session for yesterday. So we'll have something tomorrow. I'm sure it'll be in Telegram and email and stuff on how to get in. I don't know if it'll be in this room or in a dedicated Zoom room, but of course, we'll be back later this afternoon in closing playbook.
Indeed, indeed. All right. See y'all.
Bye.